Hey everybody, Chris here with Tomorrow Mastery. Today we're going to be talking about some tax bracket basics and how your investments are taxed. As a reminder, I'm not a financial or tax advisor, and you should always do your own research and maybe check with a professional before making a financial or tax decision. Go ahead and squash that like button for the YouTube algorithm and subscribe to the channel. Let's get started. So, if you've ever made money in the US legally, you know that the IRS wants its cut. This is called ordinary income tax. Here we got the income tax breakdown. First up, we have the federal tax. It's broken up into 7 different brackets ranging from 10% to 37%. Next up, we have the Social Security and Medicare tax, which is 7.65% as an employee. And if you didn't know, your employer also is paying 7.65%. And if you are self-employed, you are both employee and employer, so you're paying both halves, coming out to 15.3%. Finally, we have the state tax, which varies greatly from state to state, ranging from 0% in states such as Florida or Texas, and it goes all the way up to 13.3% if you're a lucky resident of California. For the purpose of this video, we'll be focusing mainly on the federal tax because state tax, it varies quite a lot and there's a lot more breakdowns and different laws per state. So, what does this mean for your investments? Well, the IRS recognizes that the long-term investments are actually a good thing and they want to encourage it. So, they allow a lower tax availability in the form of long-term capital gains. So, what are capital gains? Basically, when you make a profit from an asset such as stocks or bonds, precious metals, real estate, or property, like Pokemon cards, they are taxed as a capital gain. Now, to qualify for a long-term capital gain, you can be there's a lower tax percentages, as you can see on the screen, between 0, 15, and 20%. And if you remember from the previous slide, that's much lower than the maximum of 37%. In order to qualify, you would have to hold a capital asset for more than 1 year. And on the side of dividend distributions, you would have to own the common stock for more than 60 days. As a side note, this 60 days is from the ex-dividend date, which is when the dividend earnings is declared at the time of when you own the stock. Whereas the distribution, it could be a day or a few days or even a month after the ex-dividend date. So that's something to keep in mind. But as a dividend investor, having that one distribution not qualifying or 2 distributions shouldn't be really a big deal because your horizon for investment is, several years. So at the end of the day, those qualified dividends, it's not a big deal. You shouldn't be trading in and out of dividend stocks. So in case you didn't know, we have an example I can give you. Is recently YouTuber Logan Paul bought an unopened pack of first edition Pokemon cards and sold the packs individually, netting himself a really nice $200,000 in profit. And I'm mentioning this because, he's definitely in the highest tax brackets and he had to pay the maximum federal income tax of 37%. That comes out to $74,000. Now, instead, if he had held on to those packs for a year and 1 day, thanks to the long-term capital gains tax, he would only have to pay 20%, and he would have saved himself $34,000 in federal taxes. So, I have another good example of how you can take advantage of long-term capital gains. Right now, Webull is running a promotion until the end of the month where you can get 4 free stocks just by signing up and putting $100 in. 2 of those free stocks can go up to $1,600. and the minimum for the 4 free stocks is $21. So what you could do is you could sign up on the link below today while you can, and you can hold on to the stocks for a little over a year, and then you sell it, and there you go. You can take advantage of the capital gains, long-term capital gains with lower tax percentages. So thanks for watching, and have a great day.